It's time for the Your Personal Bank Show with Ferenc Compares. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Compares.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Well, we have more news on the real estate front. Many of my clients are real estate investors. It's something I've had an interest in myself, investing in real estate. My wife and I at one point had owned 32 properties. We started in 2001. We were located in Phoenix. We did really well for several years, and then 08-09 happened. And by that time, we were developers. We were buying land, bringing in the utilities, the roads, building houses. And at that time, I didn't realize the risk involved in being a developer, so we took quite the hit financially. We got slammed through that whole process. And I was discussing this with a longtime client of mine. In fact, we were doing a review of one of her Your Personal Bank policies. She had it now 8 years. It's been growing for her, doing quite well, insured with guarantees, tax-free. We're actually moving her to a better product. You can do 1035 exchanges. That's a non-taxable event. That's something folks ask me sometimes. We're always looking for the best product available, obviously, at any given time for a client. But when sometimes a competitor steps up and offers a better product, we can do 1035 exchanges, rollovers, things like that. If it happens to be an index annuity with a penalty, we often can overcome that penalty and then some. I'm going to share a story later today of another client I worked with this week where we did exactly that. It was kind of interesting. We put them up almost $100,000 day one as a result of the difference of the bonus minus the penalty. So they were quite happy. But going back to this client, this worked with for the past 8 years, she's a real estate investor, and it's a similar story I'm hearing from most of my real estate investors. She's taking a pause. She's been looking at properties. The numbers just don't make sense right now. The prices are too high. The interest rates are too high. And one of the things I shared with her is, based on my experience, I stated, if I had a time machine and I was able to go back in time and tell myself in 2007, before the 08-09 crisis, what would I have done? Certainly, I would have done some things differently. I would reduce the risk, reduce the exposure that I had at the time. But the other thing I would have told myself, and as I shared with her, is this too shall pass. Because one of the points she made is, she's like, gosh, it doesn't look like real estate's going to be a good investment again, I don't know, for years maybe. I pointed out, real estate moves slowly. Real estate prices are too high, regardless of how you want to measure it. I know owners of properties don't want to hear that, but it's a fact. And the reason why real estate prices move so much slower than, say, stocks or other types of assets is owners of real estate are slow to realize that they can't get the prices that they were getting maybe a year or two ago. And it's a slow process. It takes usually 2 to 5 years, peak to trough, for a typical real estate cycle. We've seen the highest increase in real estate values in history, at least for the United States. Prices of home to medium income have increased at the largest rates we've ever seen. I shared this not too long ago, but in 2005, the median salary was $46,000 and the median house price was $184,000. So a little more than 3 times the average income was the average house price. In 2026, the median salary is $59,000 and the median house price is about $450,000. So salaries have increased about 28% over the last 20 years, while house prices have increased 150% on average. House prices versus median income, we're well beyond twice as high as we were in the 08-09 crash. Things will resolve themselves. We are seeing declines in prices. I believe we will continue to see that for quite some time. It typically starts in markets that are overextended the most or had the biggest run-up, places like Austin, Florida, Texas, Phoenix, Colorado. But it'll spread. The corrections might not be as strong in some of the markets that didn't go up as much, but they're going to be affected too. But as I pointed out to her, the best advice I could give her right now was be patient. And a lot of my real estate investors that I work right now are doing exactly that. They're stockpiling cash. They're investing. Your personal bank is a great place to put it. You can grow your money insured with guarantees, tax-free, highly liquid. That's what she's doing. She decided to increase her contributions and do a new policy. And we're 1035 exchanging from an existing one to increase the returns. We're increasing her returns by about 25%, reducing her fees. But it'll give her access to more cash for when the next opportunities do present themselves. For somebody who's looking to purchase or an investor wanting to invest, and they don't have to do that right now, well, do you really want to catch a falling knife? And that's why it's not hard to understand why housing demand has fallen to the lowest levels ever recorded. I've shared this in previous shows, but there's a housing demand index that measures from 0 to 100, 50 being average market. It's recently been hitting levels of recordings of 5. Level of housing demand, buyers, is 10 times below the normal. And it's for all these reasons, and the biggest one being prices. Some people blame interest rates, but they're only using the interest rate argument because of perception of the super low interest rates we had most of the past decade. If you look historically, the average interest rate environment is pretty similar. We're pretty close to average right now. So maybe we're a bit on the high side, but not by much. And what my predictions are, some people are looking for when the new Fed chair takes over in May, that's appointed by Trump, they're expecting some interest rate reductions. I think we'll see some. I don't think we'll see the significant drops where 3% 30-year fixed mortgages, anything like that. And I believe the administration is going to take some steps to impact mortgage interest rates somewhat. The midterms are coming. It's good politically. Could we see some 5% interest rates later this summer? Maybe even high 4s? Yeah, I think that's a possibility. But 5, 6, 7% is pretty normal. The real problem is not interest rates. The real problem is the price of real estate. That's the biggest jump we've seen, again, in history. And median income has not kept up anywhere close to the rise of the cost of real estate. The other issue we have going on with real estate is investors. Rents across the country have now dropped about 10% on average. Some markets as much as 20% or more. And a 10% drop in rents might not seem like a lot, but for a landlord and investor, that's huge. A 10% drop of rental income can amount to 50% of their profit or more. So you've just cut their profits in half. If they're looking to buy, prices are high. Interest rates are average to a bit high. Regulations in some markets, as this client is in Washington State, as she stated, it's so much more difficult today than it was 5 or 10 years ago because of renters' rights, the political environment. Anywhere along the West Coast, that's the case. But also insurance. Those types of things have gone up in many parts of the country also. So when you add all this up, the profitability for a landlord has been severely squeezed. And for the properties that are coming up for sale now, a good chunk of them are investor properties now because understand the typical, something like 80 to 90% of the homes that are available for rent are owned by what you would consider mom and pop landlords, folks that own less than 10 properties. They can't afford this type of squeeze. The profitability is not there. So the investors are starting to lead the charge in terms of price drops on real estate, and I believe that will continue for some time. Another area that's leading the charge in dropping prices are the home builders. I've shared this before also. Lennar, the second largest home builder, is now selling homes, similar floor plan, similar size, 25% less than they were just 2.5 years ago. The average Lennar home in third quarter of 2022 was selling for $490,000. That same home is now selling for about $370,000, or in other words, $120,000 less, for basically the same home that you could buy 2 or 3 years ago. This puts another group of people, those that bought homes in 22, 23, 24, when they were overpriced. They bought into the whole idea that housing prices never went down. That's not true. Depends on the market, certainly, and the economy. But many of those people are now already underwater on their properties. if they face an income challenge, they're in trouble. So that'll be another pressure, in my opinion, to the downside in terms of real estate. I think the picture is going to get a lot uglier before it gets better. That is the reason why I have more and more real estate investors contacting me, both folks who have been clients of mine for years and new listeners who are now telling me they're selling the properties or getting out. They're done because they don't see a good road ahead, certainly not for the next several years. It's going to be a rough ride. Opportunities will present themselves just like they did after 08 and 09. As I told this client of mine, 2011, 12, 13, those were great times to buy real estate. Prices were really low, weren't they? And I don't know if they're going to drop to that extent as they did from the Great Recession. More and more believe we're going to see a significant drop in prices. Not for the same reasons as in 08, 09, but a similar result. So my advice to you, if you're looking to sell, you might want to sell sooner than later because it doesn't look promising that prices are going to be strong for quite some time. Exceptions to that rule could be places like in the Northeast where there's still a shortage of inventory. You have to look at your local market. If you're looking to buy, same advice. If you don't have to buy right now and you can wait, might be a good idea to wait. Rent prices are dropping, continuing to drop. As this investor she shared with me, she's got a number of multifamily residences. People are struggling or realizing there's cheaper rent elsewhere, and she's negotiating down for the people that are paying just to allow them to stay. If you're in a rental situation, you might be able to negotiate a cheaper rate. Opportunities will present themselves, but you got to be patient and ride the wave, not try to go against it. Stay tuned in the next segment, because I got some information about jobs that will be very interesting. I'm Ferenc Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. In the first segment, we were discussing some of the current and ongoing issues with real estate. But to add on to that, we've got some other issues in terms of actions that the government is doing in terms of spending and jobs and HB1 visas. Here's an example of government overspending that's just egregious. Do you realize that New York City's annual budget is double of Tokyo's? Yet Tokyo has twice as many people, has a cleaner environment, superior public transit, far superior, much lower crime rates, almost no homelessness, and better public education. And to take it another level, New York City, with its population of about 8.5 million, just proposed a $127 billion budget. That turns out to be about $15,000 per resident that the city is spending. And yet they're still projecting a $5 billion gap. They want to close that with a 9.5% property tax hike and raiding the rainy day fund and the teachers union pension. At the same time, the state of Florida, with almost 24 million residents, 3 times bigger than New York City, its budget is smaller, about $117 billion. It averages about $5,000 per resident. So the state of Florida is spending about 1/3 of what the New York City is spending. And the state is responsible for far more than a city is. Florida also does it with no deficit and a surplus, no emergency property tax hikes, and no raiding of retirement trust funds. Florida currently has almost $17 billion in reserves and routinely run under budget and return money to taxpayers. And again, they have more responsibility for education, infrastructure, etc., than New York City does. The only reason is it's an egregious waste of taxpayer money. Some people respond with, well, we need to raise taxes on the rich. They need to pay their fair share. The total wealth of U.S. billionaires is about $8 trillion. If we were to confiscate all of their wealth, every bit of it, 100%, do you know that would run the federal government for just over a year? That's it. So the problem isn't so much how much billionaires have, but how much politicians spend. We shouldn't be asking about about paying your fair share. We should be asking the question, what are you spending the money on and why? And part of the problem comes from, do you know that we have 55 million foreigners on visas? 14 million are foreigners on green card with permanent residency. We have an unknown number of illegals. Currently, the Labor Department states there are 3 unemployed Americans for every job guaranteed to a foreigner. This adds up to about 3 unemployed Americans for every job guaranteed to a foreigner and a second job guaranteed to their spouse. H-1B visas typically are granted before a company lays off more American workers, forces those workers to train them, and this is even with companies that get awarded billion-dollar government contracts like FedEx did recently, and then fired a bunch of American workers. These are numbers according to the U.S. Labor Department. We have about 50 million foreigners that have permission from the government to work here. Depending on what information you research, we have between 30 and 50 million foreigners with permission to live and work in the United States. We also have an unknown number of illegals living in the United States. At the same time, about 50 million Americans live near the poverty level, and another 44 million live in the poverty level. Why do we have 44 million Americans, citizens, living in poverty, while we have 30 to 50 million foreigners living and working here? But on top of that, if AI truly does replace the vast amount of jobs that are predicted between AI and robotics, why do we have all these people here for jobs that aren't going to be needed soon? See, it makes no logical sense unless you consider that some people are benefiting from that. And frankly, a lot of those happen to be politicians and bureaucrats. Again, if you want to understand something, follow the money. There was clearly benefit for those in power. According to Department of Homeland Security, during the Biden administration, 8% of the entire population of Nicaragua entered the United States illegally. 7% of the Cuban population, 6% of the Haitian population, and 5% of Honduras. We imported, legally and otherwise, significant percentages of entire countries into the United States. And this is why Americans in general are not getting richer. See, here's the real problem. Since 2020, the average wage in the United States has risen 31%. Now, on the surface, that sounds good. After you factor in inflation, real wages, which is the difference of your wage increase minus the inflation, wages have only increased 3.7% since 2020. We've had massive stimulus. We've been told there's been a strong economy. Gas utilities have increased over 50%. Electricity over 40% on average. Auto insurance about 50%. Used cars 30%. Home insurance is up 14%. When you add all these things up, it eats into those wage increases, which means, again, the real wage growth has only been 3.7% since 2020. When wages in real terms barely increase, yet the fixed costs explode, many households resort to credit to bridge the gap. Savings and then credit. This is why we've seen repeated all-time high credit card debt and all-time records of debt for U.S. households. This is going to lead to a significant volatility. It's frankly not good news for the economy and the markets for that matter. An economy doesn't break when GDP turns negative. It breaks when the math stops working for the middle class, because that's where the real money is. And much of the problem has been caused by both legal and illegal immigration. One of the major failings of our modern immigration system is it doesn't weed out people anymore. It doesn't weed out the undesirables. Ellis Island era, 30 to 40% of those immigrants were refused and sent back. And they didn't have access to welfare. They also had to have a sponsor, a job or way to make a living lined up. These costs continue for years and even generations. According to Housing Secretary Scott Turner, 50% of anyone on subsidized housing stays there for more than 15 years. Half the people receiving discounted housing have basically made it their career to be on government benefits. And that's why these work requirements and time limits being put into place are so important. Other studies show that immigration has accounted for roughly 2/3 of all rental demand growth since 2020. And in states like New York and California, immigrants have accounted for 100% of the rental growth and over half of owner-occupied housing growth in recent years because of the influx of population. These folks have to live somewhere, right? And we all know there's been government subsidies and all kinds of things, FHA loans, you name it, to help them not only rent and or purchase homes. So going back to the real estate, as I was sharing in the first segment, another reason why I think we're going to see this housing bubble burst is housing prices and rental prices. A large part of it was nothing more than a measure of people coming into the country. In 2025 was the first year in over 50 years where there was fewer people in the United States. And the projections are 2026 will be far greater than that. These are all things that will lead to a collapse in housing prices, which will impact the economy, will spill over into markets, will create volatility. Uncertainty creates volatility. What do? Protect yourself. Protect the downside. We have index products, the best we've seen in over 40 years. I'm going to encourage you to stay tuned in the next segment. I'm going to share some more about this, but unlimited upside gains, no downside losses, principal's guaranteed, and when you get a gain, it locks in. In last week's show, I even dispelled some of the myths where one of the biggest ones is to obtain guarantees, you have to give up strong growth. That's not true anymore. I'm going to share a case. I worked with a client this week where they had one of the new hybrid annuities. I'll explain more about what that is. Versus the index annuity, the hybrid annuity had more limited upside growth with some protection to the downside, while the index annuity had unlimited upside growth, lower fees, and no downside risk. Stay tuned. I'll share with you the difference. This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, or you can go to the Your Personal Bank app. Again, it's yourpersonalbank.com. So one of the meetings I had this past week was very interesting because we were dealing with one of what's called the new hybrid annuities. I haven't shared much about this yet, but it is becoming more and more popular. So I should explain, first of all, what it is, and then I'll share with you what the strengths and weaknesses are, and where we found where an index annuity was a far better option. And here's the reasons why. Now, first of all, what is a hybrid annuity? A hybrid annuity is basically a hybrid between a variable annuity and a fixed index annuity. And this is one of the biggest misconceptions I get for folks who are first looking into annuities or not very familiar. They'll hear different positives or negatives. They'll ask me, what about annuities? And the first question I have is, what type are you talking about? Because unfortunately, there's like 5 or 6 different types of annuities. There's immediate annuities, like your pensions. Anybody who's on a government or teacher, railroad, postal type of pension, those are annuities. So are lottery winnings and things like that. That's where an insurance company pays you a guaranteed amount of money for a certain number of years or lifetime. There are multi-year guarantee annuities. Those are much like a CD. In other words, an insurance company will pay an interest rate guaranteed for a certain number of years, just like if you bought a 1 or 3 or 5 year CD. There are fixed annuities. Fixed annuities pay a fixed interest rate, much like a 1-year CD, but each year the fixed interest rate can change based on current interest rate environment. There are fixed index annuities. Fixed index annuities have the fixed aspect along with an index or opportunity to invest in a number of indexes. I share many of them. Oftentimes there's various S&P 500, NASDAQ, AI, gold indexes, you name it. There's literally hundreds of them. I have a index performance report that shows the 1, 5, 10-year results of all these different indexes, everything from Goldman Sachs, Merrill Lynch, you name it, okay? Anything you can imagine under the sun. And these indexes allow you to grow your money based on whatever the index does. Some have caps, some have unlimited upside. Some have fees, some don't. Some have accelerators on participation rates that allow you 200% and 300% of what the index does, and they offer far less than that. It depends on the product. Some are good and some are not. And I've shared that many, many times. Some of my favorite products have the unlimited upside with no fees, no caps, so again, unlimited, and you get most, if not all, of the upside participation. Those are the ones that average 10, 11, 12% annually over the past decade plus with no downside risk. And when you do get a gain, you lock it in, that becomes the new principal. So index annuities are very popular. There's also variable annuities out there, and those are based on different indexes or mutual type funds where they can go up, down, sideways based on the market. And the advantage all annuities have is tax deferral. So that's one of the reasons oftentimes people invest in them, because leave the money in there, it's going to grow each year, year in and year out, without having to pay taxes, so you can generally grow your money faster. But the variable annuities do have the unlimited upside, but they also have the unlimited downside risk. Well, hybrids fall between the index annuity and the variable. And so what they do normally is, and there are variations, please understand, but they generally will allow you a certain upside potential gain. Some have caps, some don't, like I said, just like the indexes. Some have fees, some don't. Again, just like the indexes. They'll protect the downside to a point. They'll often have what's called a buffer, or in this particular case, I'm going to use an example of one I dealt with this week. They had options of a 10 to 40% buffer. Well, what did that mean? Well, it mean if the index they were invested in went down, lost money, the buffer would reduce the amount of the loss, anywhere from 10 to 40%. To use an example, if the index lost 10% in a year and they had a 10% buffer, their loss would be 9% instead of 10. If they had a 40% buffer, their loss would be 6% instead of 10. Hopefully that makes sense. So it's buffering or limiting the downside. It's not eliminating it, but it's limiting it. That's typically what a hybrid annuity would do. And in theory, most people believe or would think that the hybrid annuity has more upside with some limited downside. Again, the variable is all the way up, all the way down. Unlimited upside, unlimited downside, right? The hybrid is kind of in the middle where you've got upside, and most people think greater upside with limited downside than an index, and they think the index has a more limited upside, but that's not the case. That used to be the case, to be fair. If we go back a few years, the products that were available, the interest rate environment we were in, they were just not as competitive. But that's all changed. That's why I keep sharing. It's a golden era of fixed assets. It's literally the best time in 40-plus years for these products. This isn't hyperbole. I'm not exaggerating. It's the facts. Some people think, oh, gosh, too good to be true. No, it's what's really happening. With this client, they had a hybrid annuity. In their case, so I'm going to use a specific example here. It was one of the better products that are out there. Their upside caps, annual caps on S&P 500 indexes, for example, was between 11 and 17% per year. So in other words, if the index went up 20, they would get between 11 and 17, but depending on which option they had chose. They had buffers between 10 and 20% to the downside, which meant if the index dropped or lost value, their loss would be reduced by 10 to 20%. Again, a 10% loss would be they would have an 8 or 9% instead of the full 10. Now, the other parts of this, when we added up all the fees and everything else involved with it, their fees were a couple of percent. It was about 2.5%. They had a fairly strong upside potential gain, but it was capped. It was limited in how much they could make in a year, between 11 and 17%. And they were still subject to downside market risks, but it was buffered or reduced to a small degree, 10 to 20%. Well, we compared that to one of the better fixed index annuities. Now, again, you can pick a bad index. You can do that with hybrid annuities or variables by the way, too. There are bad indexes and there are good ones, just like anything else out there. And the 80-20 rule applies. So I don't care which product you're looking at. 20% are really good and 80% are pretty average or below average, poor performers. But based on the better returns, the better ones are historically average, I was able to show them an option index where that same S&P 500, unlimited upside, no cap. That's favorable. No fee. Well, that's much better. And participation rates that ran from 75 to 165%. What that means is if the index went up 10%, for example, they would get 7.5 to 16.5% credit, depending on which index they were in. The question always comes up, well, why wouldn't I choose the higher participation rate? I want the 165. On the surface, that sounds great, but there is a bit of a caveat to that. I use the analogy of if you want to win a horse race, you need two things. You need a fast horse and a good jockey. And what I'm referring to here is the jockey, the 75 to 165% participation rate. Well, the 75% participation rate is a jockey that's holding back a little bit. You could have a fast horse, right? The index is the horse. You want an index that's going to perform well, do well, historically, consistently, most years. The 165% participation jockey is spurring the horse on. So in other words, a 10% return means you're going to get credited 16.5%. And by the way, folks, there are participation rates out there that exist that are 200 and 300%. They do exist, but here's the caveat. Those are generally tied to indexes that don't perform as well. In other words, tends to be a slower horse. So what we're looking for is the combination of the fastest horse with the best jockey. I mean, you might find a super fast horse with a kind of poor jockey, or have a horse that's pretty darn good, pretty close, but has a really good jockey and can spur him on to do better. Does that make sense? Because of the participation rates. Remember, we're dealing with, I tend to prefer no cap, unlimited upside, and no fee products. You keep everything. That's obvious. Low or no fees are always best. With the best participation rate available on the best index, the best combination of the index and the participation rate. Like I have one index, for example, that has averaged little over 13% in average annual returns for the past decade. This is documented fact. I can show it to you. It's an S&P 500 index. By the way, there are dozens of S&P 500 indexes, variations out there. So it's not just because you got an S&P doesn't mean you have the best one. There's good ones and there's bad ones. Again, the old 80-20 rule. But I've got one that's been a really good performer for well over a decade, has averaged 13%, like I said, just over the past decade, and it has a participation rate of 85%. So if the index goes up 10, you get 8.5. Goes up 13 on average year, the average return to my clients has been about 11.2 over the past decade. Well, those are strong returns. But there's other indexes, like I show oftentimes, same product, by the way, 200% participation rate. In other words, if that index goes up 10%, you're going to get paid 20. But the index is tied to averages about 3.5%. So your average return is going to be about 7. So although you've got a great jockey, a 200% participation rate, no cap, no fee, you got a really slow horse. Or would you rather have a really fast horse with a pretty darn good jockey? Not the best, but pretty darn good, which averages you a little over 11% returns. You see my point? These are the things I share with people when I do a Zoom meeting, when I meet with them and explain to them so they understand the difference. And once they understand the difference, like these clients did, the difference of the hybrid annuity versus this index annuity with strong horses and strong jockeys, strong indexes, no fees, no caps, good participation rates. The historical average of the returns of the hybrid was less than the returns over the past decade of the index product. And here's the other major advantage of the index product over the hybrid, or the game changer for them. The index product protects the downside 100%. The principal is guaranteed, and each year you lock in the gain, that becomes your new principal. The hybrid, their downside was buffered. If the index went down, they would not lose all of it. 10 or 20% of the downside was protected, but the rest was they were still subject to it. So here you have a product that has historically outperformed using the exact same index. So by the way, so if the index does better, both will do better. If the index does worse, both will do worse. So they're based on the same index, folks. Has unlimited upside, no fees, and has a strong participation rate and no downside risk. Well, it becomes a no-brainer. It's a game changer. And that is why I'm such a fan of index annuity products or index products versus hybrid products. Now, there's no argument here. There are some hybrid products that are better than some index products. But if I line up the best index products against the best hybrids in every situation I've dealt with so far, and I deal with this every week. I've been in the index annuity business. This is my 26th year. When I compare, and we compare and look at the differences, the best index annuity products outperform the best hybrid annuity products. Now, there may be an exception out there I haven't seen yet. And if you want to find out if your index product or your hybrid product or variable and whatever it is, you want me to compare, no cost, no obligation, I'll show you. I'll show you the difference. But what I'll be able to bring to the table for you are the best indexes, the fastest horses out there with the best jockeys. Most cases, very low or no fees, unlimited upside, no caps, great participation rates, and gets you the best returns historically, consistently, on average. And again, if the index goes up or has a higher return, both products would have a higher return. If the index was less, both products would have a lesser return because they're based on they're based on the same thing. They're based on the same index for the most part. That's what I do for clients. That's the difference maker, and that's the educational part of them better understanding of what they have and why they have it, and why my clients do average after they switch. And we look back to what they were doing before, and then we do a 1 or 2 or 5 year review or whatever, and we look back to where they were. Their average returns are double, triple, sometimes even quadruple, and I have had a few cases of 10-fold increases in average returns than their previous products. I've had folks make up to 28% in 1 year on an index annuity product. If you want more information, contact me at yourpersonalbank.com. And let me share, in the next segment, I want to share one more aspect and a question that often gets asked about whether you should do a bonus product or not. This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me or the Your Personal Bank app, but it's yourpersonalbank.com. If you missed the last segment where I was sharing really the difference of the different type of annuities out there, including the new hybrid annuities, and why I have found, based on many cases comparing the best index annuity products are superior to the hybrid annuity products. They have a higher upside potential gains in good years and no downside risks in the bad years. The hybrids have a limited downside risk, mitigated, but still it's there. If you missed it, go to yourpersonalbank.com. You can listen to this or any of the previously recorded shows. I think I did a good job of explaining the difference and why. Now, the other thing that comes up quite often is bonuses. Now, there's a place for bonuses, certainly, and if you have let's say you have an index annuity or hybrid annuity or even a variable and you're not happy with the returns, and let me give you a good rule of thumb. If you haven't gotten at least a 7% return over each of the last couple of years or so, or better, you're in a subpar product. I don't know how else to put it. Many of my clients have been getting double digits over the last couple of years, for example. The lowest that I've been seeing is in the 7-8% range and higher. And every review I've done now for the last, 2 years on index annuities. If you're not seeing that type of result, actual returns, net of all fees, actual difference in your account, folks, you are in a subpar product. It's not performing as it could or should. You should consider comparing and making a switch to something better. Now, the hesitation many people have is a penalty. Let me dispel your concerns about penalties. Here's why. The example I was sharing with in the last segment, looking at that hybrid annuity, in their case, they had a penalty of about 5.5% to get out. I've seen penalties double digits to get out. That's not a problem. We have products that will pay 22 to 29% signing bonus, depending on the time frame you're looking at and et cetera, and what state you're in. There's some variations. But in this particular case, with this client I met with this week, they decided to go with the 29% bonus option. Well, based on the amount, and they had a 5.5% penalty to get out of their existing hybrid annuity. As I stated earlier, showing them the index product had a higher upside potential gains on the same index as S&P 500. Unlimited upside, their hybrid annuity had caps of 11 to 17% annual caps. Their hybrid annuity had a buffer on the losses of 10 to 20%. Losses would have been mitigated 10 to 20%. A 10% loss, for example, would be 8 or 9% instead of 10. Where the index annuity, principal's guaranteed, 100%, no loss. And when you get a gain, of course, the gain is locked in, and that becomes a new principal. So not only they had more upside potential on the same indexes, unlimited versus caps of 11 to 17%, they also had no downside risk. Pretty much became a no-brainer, frankly. And if you looked at the historicals, the index annuity product had outperformed the hybrid product. Like I said, in their case, they had a 5.5% penalty to get out. The new company was paying them a 29% signing bonus, which means they were way ahead day one. In fact, in their case, based on the amount of funds they had in their accounts, this amounted to nearly $100,000 increase in their account values day one. Well, that made them pretty happy. Adding almost $100,000 boost was a pretty big deal, and it would be for, I think, most people. So you're moving in a better position, and they got a huge boost getting out of the old product. So if you have that situation where you're and they had only been in this product for like a year, it had not been very long. So you could have an annuity you just got into recently, or maybe you've had it for a number of years, and you still got a penalty. Regardless, in most cases, I'm able to bring to the table a better product, better potential upside growth, and in their case, also lower fees and eliminate the downside and offer the bonus to offset the penalty and then some. So you have more money than when you started. Look, if this interests you, contact me at yourpersonalbank.com. In fact, I'm a little bit shocked. I shared some of this last week, and I did have some people reach out to me, and I do appreciate it. But I was a bit surprised that I normally get more folks respond to something like that than I did last week. I don't know if everybody was distracted or whatever was going on, but you got nothing to lose to contact me to do a comparison. And if I can show you a better product, it can offset your penalty and all of that, right out the gate and you're ahead of the ball game with a better product, and the proof is in the pudding, you have not gotten very solid results. Again, if your results have been less than 7% each of the last couple of years, you're in a subpar performing product. That's just the facts. There are too many good indexes out there today that have been performing, and if they do that in the future, will continue to do so. Look, and I understand, past performance is no guarantee of future results. I understand that. We've all heard that one. But when you look at these, indexes, and again, I have the index performance reports, 1, 5, 10 years. And you look at indexes that have never, I could show you indexes that have never been done more than 3% ever. And then you're looking at other indexes that are averaging, 10, 12% annually, on average, over the past decade. Nearly 28% in 1 year alone recently. When you've got indexes that do those kinds of results consistently, and then you're looking at this other one who's never done anything, hardly, the difference is you're looking at a racehorse versus a plow horse. And you're hoping that the plow horse is suddenly going to miraculously turn into a racehorse. Look, I guess it could happen, and sometimes it does, but it's pretty rare. And the odds of the good, strong performing index continuing to do what it's been doing for decades even, versus the one that has hardly ever done anything, are far greater. Where would you want to position yourself? Where would you want to allocate your money for potential upside growth? I mean, it only makes sense. And then there's the other aspect, like we have an index that we're really looking at. It's a hybrid S&P 500 index. And what's interesting about this one is it has a no fee, no cap, 225% participation rate. That's phenomenal. 1 year product. It's not one of those multi-year ones. Not a big fan of the multi-year ones either, by the way, because those, if you get into the 2, 3, 5 year indexes, yes, they have those higher potential upsides, but you know what typically happens in most cases, and statistics show this? The up and down of the markets over that 2, 3, 5 years, it tends to average itself out. So your actual returns are typically less. Those are just the stats, folks. I'm just telling you what's actually happens. Back to this S&P Hybrid Index. No cap. Unlimited upside. No fee. 225% participation rate. In other words, if that index returned 10% in a year, your interest credit in your index annuity account will be 22.5%. And I had some folks that got that last year. Because why? Last year it did 10.3%. The index did. And their participation rate was 225%. So they actually got a little bit more than that, about 23% credit in their account 1 year on the money they had in an index. Now, why haven't I used that one a lot? Well, if you look at the 5 and the 10-year history, it averages about 3.5% return per year. But last year it stepped out and did a 10.3% return with a 225% participation rate. So we're keeping an eye on that one. Is this a 1 year anomaly? Or is it going to step out and continue to do well? And if it does, we're going to start adding it to our recommendation list of indexes that we recommend you want to allocate some of your funds. And here's the other thing, too, about it. You don't have to put all the money in one index or another. You can mix it up. And that's typically what we do with folks. We typically mix it up in a number of different indexes. A very simple combination we do consistently that gives you a great diversification in the markets. You're invested in 600 different companies, by the way. We use one of the S&P 500 indexes. Again, there's many of them out there. There's good ones and bad ones. You'll have to contact me and find out which is the good one. I'm not going to give out all my secrets because a competitor could be listening and stealing all the thunder, right? But anyway, you contact me at yourpersonalbank.com. I'll be happy to share it with you. And we use a NASDAQ 100 index, which is 100 companies. So if you invest in the S&P 500 index, this one that does really well, and the NASDAQ 100, which is a lot of tech stocks and 100 companies, you're diversified into 600 companies, folks, or nearly 600. There's a few crossovers. That's a wide diversification just in two indexes, and in two great indexes that have both averaged over 11% over the past decade and have done as much as 28% in 1 year. If this is not the type of results you're getting with your existing products, your investments, frankly, it doesn't matter what they are, where they're at, but especially if you're in the annuity world. you got an index annuity or hybrid or whatever that's out there that you're just not getting at least 7% or better, why not contact me and look at it alternative? And again, don't worry about the penalty. We can get that squared away. We've got companies, like I said, will pay 22, 20, even 29% bonuses, okay? We can take care of the penalties, no problem, and put you in a better product. Get you better upside going forward. Again, you got nothing to lose. And I hope some of you, reach out to me so that I can show you the difference. Give me 15, 20 minutes. I'll show you exactly the difference, and it'll be eye-opening. It'll become abundantly obvious. I've had folks reach out to me who are highly skeptical, met with me, sat down, we went through it, and I showed them, and they're like, holy cow, and they learned a ton. And many of these are some very, very sophisticated investors. Some of them never even looked at annuities or considered them before, but they were intrigued by what I was sharing. If you don't at least explore it, you won't understand what I'm talking about and how it could help you and how you could diversify and how you can eliminate some of the market risk, at least on some of your portfolio, and yet still get good, strong returns. I think one of the biggest myths that I want to dispel, maybe I'm on a bit of a crusade with this radio show and being in the industry as long as I have, again, 26 years. I've been one of the top annuity producers in the country, some of the top annuity companies in the country. And I'm not saying that to brag, just it's a fact. But I think one of the crusades is I want to dispel the general myth out there that you have to give up strong returns if you want guarantees. It's just not true anymore. And it's likely not going to be true for the next 5 to 10 years, if not longer. And again, it has to do with long-term bond yields and the government debt. Large government debt has created problems, granted, with the economy and a lot of other things, interest rates, all that. But it also creates opportunities that have not existed there since the 1970s. And to pass up this generational opportunity that you have, that you could grow your money as strong or perhaps even stronger returns than what you've been getting with risk, you can do it without risk. I don't know. That just seems to me to be something at least to take a look at and consider. And you'll soon realize quickly that it's not hyperbole. I'm not exaggerating at all. I'm actually sharing actual stories of what's actually going on with actual clients that I'm dealing with every single week. So if you want to look into this further, if this sounds interesting to you, you want to maximize your returns, unlimited upside gains, no downside risk, best time in over 40 years to look at these products. Is truly the golden era of fixed assets. Contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice.
Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.